Welcome to another episode of the Michael Yardney Podcast, when today we're going to discuss how to prosper in a financial world that's rigged against you. Now, that's an interesting claim, isn't it? But my special guest today is Rob Dix, author of the book, The Price of Money, and we're going to be discussing money, inflation, the world of finance, and how to position yourself to prosper in the current environment. So let's get on with the show so you can learn some valuable lessons on financial success.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
While the focus of this podcast is usually about property, there's always the underlying theme of finance and money. And quoting the words of one of Britain's best respected finance experts, Rob Dix, who's my guest today and author of the book, The Price of Money, we spend our entire lives trying to get hold of money, yet we've got no idea where it actually comes from. And then he goes on to say, then we're expected to make intelligent decisions about what to do with the money we earn when we're never taught how to. Now, I've been listening to Rob's Property Podcast, which happens to be Britain's most downloaded investment podcast, for quite a few years, and I've recently read his book, The Price of Money, which I found fascinating, and I thought I must have him on this podcast to share his ideas with you. So, welcome, Rob.
Thank you so much. It's a pleasure to be here.
Now, Rob, there are quite a few similarities between the property markets in the United Kingdom and Australia, and in general, they're affected by the same general economic conditions, consumer sentiment, inflation and interest rates. Now, here in Australia, the media keeps reminding us about inflation and its effect on interest rates. We've had 9 consecutive interest rate rises month after month, and that's affecting people's household budgets. But Rob, back here, it's actually affecting our consumer confidence a lot. So maybe we should actually start with some fundamentals. Rob, what is inflation and what causes it?
Well, this is something that you tend to not hear the full story about when you do get everything in the media and from politicians about inflation. It's the same story here in the UK, very similar picture. When you hear about inflation, what people normally talk about is sort of factors that are going on that affect supply and demand. And so at the moment, you hear a lot about, there's the war in Ukraine gets talked about a lot in Europe, and things opening up again after COVID. And all these things do have an effect. They absolutely do. But there's something more to it than that as well, which is the actual money supply. So if you go and look at a dictionary definition of inflation, it talks about a sustained increase in prices over time. But the definition includes related to an increase in the supply of money. And that's the bit that politicians tend not to remind you about, because then it kind of implies that they've got something to do with the problem, whereas I like to pretend that they don't. This has been particularly relevant over the last couple of years, because I know in Australia it's similar, but in the UK, when COVID started, the UK government printed out of nowhere about £450 billion. And
we called it quantitative easing here, which I know that you did as well.
Yeah. And so that's a huge increase in the amount of money. And so people think about the supply and demand of goods, but the supply and demand of money is a factor as well. So it's like if you have a certain population in a city and a certain number of rental properties, then you suddenly pour loads more rental properties onto the market, then the prices of those are going to fall, right? The rent you can achieve is going to fall because you've got suddenly more supply. And it's exactly the same with money. If you add more units of money into the system, then each individual unit is going to become worth less, which is another way of saying prices go up. So yeah, all these other factors are important. But over the long term, and you've sort of seen it over hundreds of years, when the price of everything keeps going up, it can only be because the amount of money's gone up.
Well, Rob, I found it fascinating to learn how the pound, the British pound, has lost 99% of its value over the last 100 years, along the lines of what you said. In fact, it's lost 50% of its value in the last 20 years.
And the last 20 years has been a period of pretty low inflation until the last couple of years, because the target in the UK, and I think in Australia as well, for the central bank is 2% inflation per year. And so 2% a year doesn't sound like much, but then if you compound that over 20 years, it gets you close to 50%. That's just normal. So if they achieve their target, that's what happens. And then if you have years like the last couple of years, then of course it happens much faster. So if you end up having a period of inflation over the next decade where it's more like 4%, which you could very easily imagine, well, then you can do the maths and work out what that means for your money then.
Fascinating. So why is the amount of debt, both government and personal debt, why has the amount of debt exploded over the last 50 years or so, since the 1970s?
Yeah, a big theme of the book is kind of relating everything, sort of going look at what's happened over the last 50 years since the 70s, because I think something that we don't realize, because we've all been used to living in this system that we've had for the last 50 years and it's just taken as normal, but actually by historical standards, it's completely abnormal. So we won't go into the full history of it, but historically, money has tended to be anchored to something, typically gold. And that kind of gives you some kind of constraint on money creation, because if you've got a banknote or a coin or something like that, that's representative of some amount of something real, like gold. And so because you can only pull a certain amount of gold out of the ground, you can't suddenly go and create a whole load of money out of nowhere. That's been weakened at various points through history because of war. It then got weakened sort of again in the 1930s. But then it was 1971 when that got completely done away with. We went into an era of fiat currency, which basically means money that has value because the government says it does and no other reason, which then takes the brakes off money creation and debt creation and everything else. And so there are lots of charts in the book that kind of go and show like sort of money creation and the amount of debt and so on throughout history. And you just see a line that if you zoom out far enough, it's almost like completely flat for hundreds of years. Then it gets to the 1970s and suddenly takes a huge leg upwards. And it's like, this feels normal, but it really, really isn't.
That's fascinating, and I got a lot of benefit from your book, and I'd really recommend The Price of Money to people. Now, to be fair, I got the Kindle version, I got the original one. I actually got it right at the beginning in the first week because I get your weekly newsletter as well, and I'll leave links in the show notes for where people can get that, because now there's a new version of it. You've been picked up by one of the biggest publishers in the world. Congratulations.
Thank you. Yeah, the book did so well on its release that some publishers got in touch. I ended up signing with Penguin, who are going to be re-releasing a new edition, which is all updated because a surprising amount has happened even in the last 6 months since I wrote it. There's a new chapter at the end as well, and so that's going to be available as a print and audio and Kindle book in Australia as well.
Fantastic. Well, I'll leave a link in the show notes. Now, in Australia, we suffered from COVID like you did. And I remember it was just over a year ago, the war in Russia and Ukraine started. And I mean, who would have thought it would still be going? And those things, as you said a moment ago, were often blamed for inflation. But in your book, you explain how policies that were introduced to survive the crash of 2008, we called it the Great Financial Crisis. Different people called it global financial crisis. I had a mental blank for a sec. Different countries called it different things. But I remember 2008 very well. You believe that started to cause inflation. What do you mean by that? Maybe you could explain that to us.
Yeah, so in the book, I've got a whole chapter about the events around 2008 and then another chapter around the events of 2020, because they're both like really pivotal years in terms of how the monetary system's developed. And in 2008, that's when in the UK, we had quantitative easing for the first time. So this basically government, sort of central bank creation of money. And at the time, everybody thought that this would be inflationary in terms of consumer prices because, as we discussed earlier, you're creating a whole load amount of money and you're chucking it into the system. As it turned out, it wasn't in terms of consumer prices. And in retrospect, we sort of can see why that's the case. It's because because of the mechanism that was used, that money never made it into people's pockets. So it didn't go out to consumers in a way that they could spend it. It ended up just stuck in the financial system. But because it was all this money was washing around in the financial system, it pushed up asset prices. So in most of the world, who went down the same route in 2008. You've had a huge asset price boom ever since 2008 because suddenly there's all this extra money washing around. So that's been a huge tailwind for everyone who's been trying to accumulate assets over the last 10, 15 years, which is great if you've been accumulating assets, but not so great if you've been unable to do that. And so it's opened up a real divide between people who were of an age and in a position to be acquiring assets back over the last decade, and those who were unable to do so, want to do so now, and find that prices have been pushed way up.
Well, in Australia, there were other factors as well. We had a mining boom, and we had a lot of Asian investment in real estate in Australia after that global financial crisis. They saw us as a relatively safe haven, Rob, with regard to our economy, politically, also, I guess, militarily. Now, I love the discussion in your book about how the government created money out of nothing to pay the bills over COVID. Similarly, our governments went into a huge amount of debts here in Australia, but you also explained that that was why we've now got inflation today. Maybe you could share your thoughts about this, Rob.
Yeah, that follows on really well because we've talked about what happened in 2008 where money was created, but it didn't make it into people's pockets. Then in 2020, we had more money creation, more quantitative easing, which did make it into people's pockets. That was the whole point of it. So what we had, and like you had as well, was had basically the whole economy got shut down. So the government needed to find a way to support people. And different countries did it in different ways. So in the US, basically loads of people, millions of people lost their jobs, but then they got far more generous unemployment benefits than usual, and they started mailing checks to people. In the UK, people kept their jobs, but the government sort of chipped in and paid 80% of the wages. But regardless of how it was done, you ended up with people needing to be supported by the government. And this was completely, of course, unexpected. So all governments borrow every year, but there's just far more. So they couldn't just go to the debt market and try to borrow it because they didn't know if the demand would be there, what price they'd be able to get it at. So all they could do was create it out of nothing. And the difference between what we talked about earlier, where it increased asset prices, and what happened recently when it increased consumer prices, is this time it wasn't just washing around in the financial system. The whole point of it was that they would get money to people so they could spend it on what they needed. But
they greased the wheels of industry, and it actually worked. And it stopped high unemployment in Australia, Rob. It actually stopped too many businesses going broke. I live in Melbourne, where we were locked down for 260 days. Not in a row, but it was the biggest lockdown city in the world. And so the government did hand out incentives, like you said, and they actually did the same thing as you. I think it was more sensible. They gave it to businesses so people could remain employed. But sure, money came out of thin air.
If you're going to shut an economy down, you have to do something to support people. I get it. You can't just say, "Oh, sorry, you're not allowed to go to work. You have to deal with it." So, but they did far too much of it. And how would you do the right amount? It's like you can't. It's impossible to figure it out. But the point is, it happened, and at the same time, nobody had anything to go and spend it on. So what you ended up with is you had a huge range of outcomes. So you had some people who ended up really struggling because the support they were getting wasn't enough. But then you had other people who kept their jobs and didn't have anything to spend their money on, were actually making more money in some cases than they were before, but didn't have anything to spend it on. So household savings in the UK and the US, and I'm sure in Australia
and in Australia too, went to record levels. We had developed huge war chests here, paying off credit cards, putting money into what we have called offset accounts so that you're not paying as much interest, into savings accounts. We built up billions of dollars in our war chests.
Yep. And then so suddenly things open up and you can spend money again. What do you expect is going to happen?
That's exactly what happened here too, Rob.
But I think it's really interesting because it's not acknowledged here, at least overtly, that this was to cover the government's bills. But then if you go and look at the amount of QE that was done month by month, along with the government's commitments month by month, it's an exact match. So they were creating money out of nothing to pay their own bills. The Bank of England website even had like a line on there saying that they didn't, but they clearly were. And you could say, okay, well, there's nothing wrong with that. What are you supposed to do at a time like this? But I just think they don't want to draw people's attention to the fact it's happening because it sounds a bit wrong, and it'll get people worried if it turns out that we're all working for our money, but you're just printing it whenever you need it.
Yes. So in Australia, We have the Reserve Bank, the equivalent of your Bank of England, and their job is, like yours, to get inflation into a band between 2 and 3%. Now, it's undershot in the past. Now it's overshot. Now inflation, it depends if you look at the trimmed version, which the governments really want to look at, or the headline figures. The headline figure got to close to 8% in the last quarter. And the Reserve Bank has now accepted that it's going to take a couple of years, at least, probably till 2025, to come into their band of 2 to 3%. I guess they're doing that, Rob, because they don't want to keep raising interest rates too high. They're walking a tightrope. They don't want to shut down our economy completely. But I guess we've got to prepare for a period of higher inflation over the coming years.
Yes, I believe that inflation will be higher over the next decade than it has been over the past decade. So same thing here. The central bank has actually been trying to get inflation up to reach its target. So it's been battling deflation. Now it's going to be the opposite, I believe. And there's two reasons for that. One is that a lot of structural deflationary factors have gone into reverse. So globalization has probably peaked, in that everyone was offshoring all their production and getting things done abroad where it was cheaper, and that is deflationary. COVID has made everyone realize, actually, there has advantages, but maybe we don't want to be offshoring all our productive capacity, because if something like this happens again, we've got problems.
We had the same problems in Australia. We've lost our car manufacturing industry, and a lot of our imports came from China. And there's also geopolitical problems, balloons in the air and at the moment, and things like that as well. So yes, we're also lamenting that we've lost our manufacturing capacity.
Yeah, so there's lots of advantages to reversing that trend, but that is a 20+ year kind of deflationary force that is going away. So that's one reason. The other reason is that I think for central banks, and for everyone who's got debt, in fact, of which central banks have the most, it's actually quite helpful, because if you end up having a rate of inflation that's higher than the rate of interest you're paying, what that's doing is eroding your debt in real terms. And given that the amount of debt, as we spoke about, over the last 50 years has been piling up and up and up, and it's gone up even more over the last couple of years because of COVID, everyone, like central banks, businesses, individuals, everyone's got huge amounts of debt. There is no way that debt is ever going to get paid down by any conventional means. So the way to pay it down is to reduce its value in real terms. And so if you can keep inflation at about 4%, somewhere around there, then that's a level where it's like, all right, it's not kind of back to the target, but it's a sort of level where no one's moaning about it. It's not in the news all the time. People aren't asking for pay rises and getting you into an inflationary spiral. So I think if central banks could get to that kind of range and keep it there, they'd be pretty happy to do so.
Sure. Okay, now that we accept that there's going to be inflation for a while, in your opinion, where should one be investing? How should we be investing?
Well, given that I've presented something called the Property Podcast for 10 years, there's no prizes on offer. But the general bad news, I suppose, is that inflation and rising interest rates, which are what we've got, is bad news for lots of different assets. And I think those all, like the forward returns on all sorts of asset classes, are going to be worse in the next decade than they have been in the previous decade, as for various reasons, including the fact that sort of interest rates were going to zero and now they're going up again. But in this kind of environment, if you're going to be investing in something, I think real assets, the other thing to go for, because whatever happens, you've got something that people fundamentally need. So that's why obviously property is great. Everyone needs to live somewhere. Rental income tends to go up in line with people's wages over a long enough period of time, and so that's great. You've got commodities as well, but basically like real stuff that there's a genuine scarcity to and that people actually need.
Well, I'm older than you, and I bought my first investment property in the early 1970s. I paid £18,000 in those days for it. Interestingly, Rob, I went halves with my parents. I couldn't afford to do it on my own. I sold my half share back to my parents when I got married. I bought it back from my mother, and we've since built 2 townhouses on it. So I still own my first investment property, bought for $18,000. That's now worth about 2.5 actually close to $4 million, I guess I should say, with the two townhouses together. But I started investing in a period of inflation. Then our Labor government, which is our left-wing government here, came into power, and inflation rose and hard assets rose as well. Interest rates rose as well. But I've actually found, as a property investor, my best profits, other than those once-in-a-generation crazy booms like we actually had after COVID, came during periods of inflation. But cash flow management's a big issue, isn't it, when you're having to manage your mortgage payments?
Yeah, it is. And so mortgages are such a powerful tool for property investors to use, but it's something you do have to be very careful with as well. So we're finding now that mortgage rates are much higher than they were a year ago. They're not going back to where they were. Mortgage rates aren't going to go back so here you could be borrowing at sort of like around about 2%, and now it's spiked up to 5 or 6. It's probably going to settle at about 4. That's not going to go back down to where it was. Even if you are borrowing at that, then you could end up in a position where the rate of inflation is higher than that, because inflation's going to stay higher as discussed, and therefore it's you're kind of, again, your debt is being eroded by inflation in quite a helpful way. Whenever you introduce leverage, you have to be very careful. But it is a tool that you can make use of. And I think it's going to be as useful in the future as it has been in the past.
So what's the average mortgage rate in the United Kingdom at the moment for property investors? What are they having to pay?
If you were looking at a 5-year fixed rate mortgage, which is kind of the people tend to sort of fix for 2, 3 or 5 years. A 5-year, I'd say, is probably at around about 5% at the moment, something like that.
We're a little bit higher than that for fixed rate, but interestingly, 2 years ago, we could get fixed rate mortgages at 1.5%, 2%. And in Australia, what happened was a lot of people took advantage of that, but they're now coming out of the fixed rate mortgages, and they're going to be paying more than double what they were paying before. So that's one of the challenges for our property markets. But in general, our economy is doing well. Employment is very low. One of the things that we have is huge immigration. We've got a government that's wanting to increase our population strongly to help, I guess, fill out all those jobs that we can't fill with the current population growth. So we're not building enough properties. There's the undersupply of properties in Australia at the moment because building costs have gone up so much. So we definitely have some headwinds. We've also got some tailwinds that are going to make the property market improve. What I see happening in Australia, Rob, is eventually interest rates are going to peak. Inflation has probably peaked in Australia. The last figure was for the December quarter, and that's retrospective. And all the economists know, they all suggest inflation is going to drop. Exactly the timing of it, they're not sure. We believe here we're going to have probably 2 more interest rate rises, maybe 3. But when that peaks and when the world realizes, well, that's as high as it gets, inflation's under control now, I can see our consumer confidence picking up again. At the moment, consumer confidence, just because the media keeps scaring us, is very, very low. And buyers are just sitting on the sidelines, and sellers, they're just not wanting to make decisions. Is there a similar thing happening in the United Kingdom?
You wouldn't even know we were talking about different countries. If I didn't have a funny accent, then you'd think we could just be talking about Australian property. It's identical, and it's all the same factors. And it's so interesting because you've got all the kind of the consensus predictions here are for house prices to fall by like at least 5%, possibly up to 15%, which of course in real terms is even more than that because you've got inflation. And you can see why that's being talked about because, like you said, the cost of borrowing has gone up so much that you think, well, that has to decrease the asset value because it means that people can't afford to pay as much for an asset as they previously were. So that makes sense. But then at the same time, you do have the fact that prices tend to be pretty sticky on the way down. If people need to sell their property for less, they just won't sell unless they're forced to. People won't be forced to because unemployment is so low. People are keeping their jobs. The economy's doing okay. And you've got exactly the same supply and demand imbalance. We had a year of absolutely huge immigration last year as well. It's continuing to build less than need to be built. You've got all these factors that are sort of keeping the market high. Plus, of course, the fact that the last thing that a government wants is a housing crash, because that's terrible for their chances of being re-elected, and we've got one coming up in a couple of years.
It is so amazing how we are speaking the same language, just with a different accent. Interestingly, though, I'll make you jealous. Rents, we've got huge rental crisis, and vacancy rates are below 1%. I've never seen that. Rents have gone up at least double-digit growth, but in many of our big capital cities, 20% plus over the last year, which interestingly, the media is making a big fuss about ugly, greedy landlords. Well, we manage property for a lot of landlords. They're not ugly. And I don't think they're greedy either, because for many years, rents didn't keep pace with inflation here, Rob.
Yeah, but like I said, over the long term, rents tend to sort of drift upwards with wages, which drift upwards with inflation, which is, for me, one of the great things about investing in property, because everyone gets very fixated on what prices are about to do next and when they're going to boom and they're going to crash. But obviously, as you know from your first investment, if you hold on for something for long enough, it tends to go up in value, and your income stream goes up in value as well, which is fantastic. And so, yeah, we've had the same thing in terms of like rents going way up over the last couple of years, but it's now got to a point where they are historically expensive. But for quite a while they weren't. That they were just kind of catching up because they had been below inflation for a while.
Very similar. Now, I've got one more question I'd like to ask you, but I'd want to remind listeners that we're talking to Rob Dix, the author of The Price of Money, and interestingly, it's been picked up by Penguin Books, and I'm going to leave a link in the show notes. But I think the other important thing to remind you is that if you're enjoying this chat, you can go to the Property Podcast, which is Britain's most popular downloaded investment podcast, and you can see why I enjoy listening to Rob and his business partner, Rob, as well. So it's Rob and Rob giving the podcast, because there are some similarities, and you talk about very similar things, other than locations and maybe sometimes the type of property. But I'll leave links for that in the show notes. But maybe we should finish off on something maybe a little controversial. I'm not sure if you're prepared to put yourself out there, but people are talking about the economic collapse. Now, I listened to your podcast when you had Robert Kiyosaki on your show. I've had him on this podcast 3 times, where he's predicting a terrible collapse. Interestingly, when I had him on and I asked him, with all this collapse that you're predicting, which I don't totally agree with, by the way, I said, so what should you invest in? And Rob, you know what his answer was? Guns. Guns. What do I say to that?
Wow.
So,
not the answer I was expecting.
No, same here. So what are your thoughts? Is there an economic collapse coming? Is it United Kingdom? Is Europe going to go into recession? What should we worry about?
Is an economic collapse coming? Yes. When is it coming? Don't know. That's the point. The lesson that came through from the book, both in terms of looking at where we are now and going back through history and looking at what's happened over hundreds of years, it's like every system of money comes to an end. Everything that has ever been created has ended, and ended messily, and been replaced with something else. And in the case of what we've got now, it will get to a point where it's completely unsustainable. We've already got levels of debt that are completely unsustainable. As we've talked about, the only way to control it is to basically inflate that debt away. But there will come a point where that doesn't work anymore, where inflation gets out of hand, or it can't be done fast enough. It will come a point where the whole thing collapses. And we've had 50 years of currencies that are effectively backed by nothing. Historically, that's a really long time. To go 50 years of having a currency like this, very unusual. So it won't last forever. But it's impossible to say when it is actually going to end, because it's only going to happen when it can't be propped up any longer. Every institution across the world is going to do everything they possibly can to keep things propped up. It's only going to come to an end when it can't be done anymore. And that could happen next year, but it could happen in 10 years, 20 years, another 50 years. We don't know. And so it sounds like a bit of an unsatisfactory conclusion. But where I got to was like, if you go and look at any of the underlying factors, you go, this is crazy. This can't last. But you have to kind of not worry about it too much, because if you just go, I'm going to kind of hoard everything in cash, or I'm just going to bury gold in my back garden, or whatever I'm going to do. That could be the right thing to do. But there are people who are saying that 10 years ago, and they've just missed out on 10 years of a boom in just about everything. The timing is absolutely impossible to get right. I think that, you get people who are like professional doomsayers, like every year they'll be coming out with something that, the world's just about to end, stock up on your guns. But and at some point they'll be right. But I don't think you can live your life on the basis that catastrophe is just around the corner. It just doesn't work. But if you instead you just kind of keep on investing in the type of assets that the type that people are always going to need whatever happens. Like, what are people going to need when the world does collapse? Well, okay, they're going to need guns, but they're also going to need somewhere to live, and so that seems like a pretty good investment.
So not cryptocurrency, not Bitcoin.
I think Bitcoin's really interesting. And I think that I don't think it really works in a like end of civilization scenario, because like people are going to sort of default back to gold, because that's sort of been like the hard money for thousands of years. And so I think there's place, but I personally have a small percentage allocation to Bitcoin because I think it's got a lot more upside than downside, but it has to be a small enough allocation where if it goes to zero, which it could, then that's fine.
Well, Rob, thank you so much for your time. I'm going to again recommend, because I learned a lot and I thought I knew a little bit about economics and inflation. I've been a student of economics. I'm not an economist all my life. I've been a student. So The Price of Money, I'll leave a link in the show notes. Again, I'll also recommend people have a listen to your podcast, because I enjoy listening to it once a week. Thanks for your time. And I look forward to having a chat with you again, because there are so many similarities.
Yeah, likewise. Thank you. I really enjoyed this.
I hope you enjoyed my chat with Rob Dix. We're living in interesting times, aren't we? Now, in a moment, I'm going to be sharing my mindset message with you. But before I do, my chat with Rob reminded me of a famous saying of Warren Buffett's: somebody's sitting in the shade today because somebody planted a tree a long time ago. And I guess his message is that good investing is boring. I know there are investors out there who'd like to hear about how the property markets have double-digit growth, or where the next hotspot is going to be that's going to boom, or how to beat the banks and buy property with no money down. I bet you're getting those emails in your inbox as well. But in reality, for the vast majority of us, investing is boring, or should be boring. A solid investment strategy should be as interesting as watching grass grow, or I guess in Warren Buffett's analogy, a tree. Planting a tree is a long-term bet. You don't plant a tree today and expect shade tomorrow. But if you plant the right seeds in the right conditions, sooner or later, time will work its magic and you'll have a tree. And if the tree isn't growing fast enough, digging it up and moving it rarely is the solution. It's the same with investing. There's no quick fix when it comes to building and growing your wealth over time. It's about planning and doing. And that's why at Metropole, even before we talk about the next property, we start by building you a customised strategic property plan. When you chat with one of our property strategists, you're going to find their focus actually isn't just about the next property. We see it as our responsibility to look to the future on your behalf and help you find the type of property that sets you up for the next property, which sets you up for the next property. Our strategic frameworks that have been fine-tuned over 5 decades allow us to prepare for the property market reset that I'm sure is going to happen later this year when interest rates eventually peak. This is the type of information you're looking for. Go to metropole.com.au and organise for an obligation-free clarity consultation with one of our property strategists to explore your options.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Have you noticed there are 2 types of people in this world? Those who hate the success of others, and those who let the success of others fuel them towards their own greatness. Now, unfortunately, I found that most people fall into this first group. They don't like other people's successes. I guess that's why we call things the tall poppy syndrome, which is interestingly an Australian phenomenon. They don't see it overseas. They don't see it in the United States. So here's my free tip for you. be in the second group. Be in that group of people who let the success of others fuel you to even higher greatness yourself. That's the way the rich think, while the poor revel in the failure of others. Some people look at other successes and failures as a way of validating their own greatness. They pick apart the reason why certain people achieve things, or they relish in a moment when others fail. Now, both of those paths lead to mediocrity. It's easy to spot those type of folks because they use words like luck. This is an ugly truth in life. There's a long list of people who'd rather complain than actually do something about it. And as for luck, I've always thought that hard work creates good luck. So take a quick assessment on how you respond to the success of others. Does it discourage you? Do you envy them? Don't allow yourself to be brought down by those hopeless emotions. Instead, allow other people's success to fuel your own fire. Let it allow you to achieve your own levels of greatness. If somebody else can do it, you can do it too. So today, pick out someone who's doing a great job, great work, compliment them for it. Muster up your sincerest praise and generously pour it out on somebody else. And the sooner you're able to recognize and praise greatness, the better chance you're going to have of replicating it. And when you succeed, know that some people will hate you for it. When you fail, some people are going to cheer. In fact, there's not a successful person out there who isn't in some way hated for their success. But the truly successful folks are the ones who can build something remarkable with the insults that are hurled their way. Have a think about that. That's the way to live your life. Revel in other people's successes and allow them to propel you to your own greatness. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney Podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney Podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?